The stock market is currently closed right now as we review the latest market figures. As of the final closing bell on July 16, 2026 at 4 p.m. Eastern Time, Navitas Semiconductor stock, trading under the ticker symbol NVTS on the Nasdaq exchange, finished the formal trading session at $11.75 per share. This specific price level reflects a minor intraday downward movement of approximately 0.05% from its previous reference point, showing a period of intense consolidation after weeks of heavy distribution across the broader technology index. The immediate surprise hitting the tape right now is that while the general market assumes every component maker supporting the artificial intelligence infrastructure boom is drowning in immediate profits, Navitas is experiencing a massive near-term financial squeeze. The company is actively executing what executive management calls its updated corporate blueprint, which involves deliberately walking away from its legacy high-volume mobile charging business to focus exclusively on high-power configurations for massive data hubs and industrial electrification. This structural shift has caused quarterly revenues to contract to a tight band of $8 to $10 million, while quarterly operational spending remains elevated at roughly $15 million. While the typical retail investor looks at the general chip boom and expects an uninterrupted upward trajectory, the hidden reality is a deliberate, self-inflicted revenue slowdown designed to position the firm for higher margin contracts years down the road. Most casual traders setting up accounts on the Robinhood app or browsing mainstream investing sites tend to view this business through a highly simplified lens. They group it together with massive names like Nvidia stock, assuming that anything related to next-generation power management will automatically appreciate at the same rate. This general market narrative creates an expectation of clean, predictable growth driven by global digitization. Individuals who manage their own self-investing platforms look at the exploding power demands of modern graphics processing units and naturally conclude that the component suppliers will see immediate financial windfalls. When retail players use basic Robinhood stock trading features or look for general investment help on popular blogs, they often miss the complex timing mismatches between product development and actual cash realization. They assume that if massive tech firms are buying servers, then the smaller chip designers must be instantly profitable, but the financial statements paint a completely different picture. However, a deeper look reveals that managing extreme electricity density requires an entirely different hardware architecture than traditional silicon can provide. Navitas is betting heavily on wide bandgap materials, specifically gallium nitride and silicon carbide, which offer superior thermal management and switching speeds. But scaling this production is incredibly capital-intensive, and the firm faces a major new risk factor. Wolfspeed recently filed a comprehensive patent infringement lawsuit against Navitas in the United States District Court of the District of Delaware. This legal friction threatens to drain significant corporate resources, lengthen the timeline to structural profitability, and create major uncertainty around their primary technology designs. For anyone utilizing an individual brokerage account to build long-term positions, this pending litigation significantly complicates the investment thesis, contrasting sharply with the optimistic retail consensus found across various internet forums. When you study the recent technical price action, the tension between expectations and reality becomes even clearer. The stock has experienced a dramatic drawdown of nearly 60% from its previous high point, following a sharp correction once the broader market excitement around infrastructure design wins began to cool. Trading volumes have shown significant spikes on down days, indicating that institutional blocks are actively rebalancing their holdings. Large asset managers using major institutional networks like those connected to Fidelity Wealth Management or specialized interactive brokers' trading algorithms are demonstrating extreme caution. The daily price swings reflect a broader macroeconomic pressure, where high interest rates continue to punish small-cap tech names that remain years away from positive net income. Institutional filings reveal that while firms like Jane Street and Vanguard maintain passive stakes, the overall accumulation has slowed as Wall Street waits to see if the company can survive its current cash burn without heavy equity dilution. For retail participants managing their personal wealth through a Fidelity brokerage account or exploring the features of the Fidelity mobile app, analyzing a high beta stock like Navitas requires looking closely at sector momentum. Unlike megacaps such as Apple stock or Tesla stock, which possess massive balance sheets to weather prolonged legal disputes and economic slow periods, a specialized small-cap designer like Navitas operates with a much tighter margin for error. Investors looking for a diversified approach often blend individual positions with broader products like Fidelity ETFs or Fidelity mutual funds to protect their capital from the severe drawdowns that can hit single stock holdings. The volatility seen in recent trading sessions highlights why automated options like Schwab Intelligent Portfolios or a specialized SoFi robo-advisor appeal to those who prefer hands-off asset allocation over active self-investing. To understand the core mechanics of this business, we have to look at its underlying design model. Founded in 2014 and operating out of California, the company uses a fabless semiconductor framework. This means they focus entirely on the engineering, development, and marketing of integrated circuits while outsourcing the actual heavy fabrication to external silicon foundries. Their portfolio centers on integrated circuits that combine power, drive, control, and sensing capabilities into a single package, primarily utilizing gallium nitride for mobile and data center applications and silicon carbide for high-voltage industrial systems like electric vehicle onboard chargers. In past years, their primary revenue generation came from compact wall chargers for smartphones and laptops. While that legacy segment established their initial market footprint, it carried thin commodity margins that failed to produce true operating leverage, which is exactly why the current strategic pivot was initiated. This operational transition is happening against a backdrop of a major shift across the tech landscape. When a data center provider plans a massive facility expansion, they look at components that can reduce energy waste. Navitas has been working on a highly publicized direct current architecture designed to optimize power delivery for high-performance servers, boasting a substantial backlog of design wins valued near $450 million. Yet a design win is not the same as realized cash flow. It represents future promises that depend heavily on the customer actually building out the facilities according to schedule. If macroeconomic pressures cause large enterprises to delay their capital expenditures, that massive backlog could take significantly longer to materialize into actual financial results. The contrast between expected growth and actual operational timing remains a major point of friction for modern market analysts. Comment below how many shares of Navitas Semiconductor you currently hold in your portfolio, or if you prefer sticking to larger established semiconductor manufacturers. Investors who actively use advanced setups like the Interactive Brokers platform or maintain an Interactive Brokers account to execute short-term trades are paying close attention to the short interest metrics on Navitas. The high borrowing costs and volatile daily swings make it a frequent target for speculative trading. For those looking to invest online, comparing Interactive Brokers fees with other mainstream applications like SoFi Invest or Robinhood Investments reveals a stark contrast in execution tools and data feeds. Active traders who utilize the SoFi trading platform or engage with Robinhood crypto assets often look for quick momentum shifts, but a long-term investment in a company undergoing a structural shift requires a much deeper level of patience. Those holding shares in long-term accounts like Fidelity IRAs need to evaluate whether the promised margin expansion to nearly 40% can actually be achieved in the face of intense market competition. When evaluating your broader asset allocation, the choice between managed systems like an intelligent portfolio and self-investing through an Interactive Brokers stock trading setup becomes critical. Retail participants leveraging tools such as Robinhood fractional shares or managing liquid reserves through Robinhood cash management services must realize that small-cap chip firms behave very differently than consumer monopolies. For individuals who prefer SoFi active investing, review specific SoFi stocks, or trade specialized SoFi ETFs, the current setup in Navitas represents a classic high-stakes battle between public narrative and corporate execution. The general market expects a frictionless transition into the high-power server market, while the underlying financial metrics reveal an expensive, multi-year construction process that could easily be disrupted by macroeconomic shifts or aggressive legal maneuvers from competitors. Looking forward, the future trajectory of the stock hinges entirely on three distinct scenarios. The optimistic path requires an acceleration